today. This is our July monthly meeting, and basically I'll take us through an agenda of what we're hoping to accomplish today. We're going to have a couple of people from Appleseed Capital going through kind of just green banking presentation. We're also going to talk more about 350 Chicago and what we do and how you can get plugged into our chapter. There's going to be a Q&A discussion section after the presentation. So if you have more substantial questions, I guess, that might veer us off in a different direction for a while, maybe we can hold those towards the end. But as we're going through the presentation, Matt and Colin have said that if you want to use either the chat function or unmute yourself to maybe ask a clarifying question, you're open to do that as well. Without further ado, I guess, also I'm Kyle and I'm with 350 Chicago, one of the board members. We have a few other people from the core volunteer group here as well. We have Kathy and Jean and Jerry here as well, but we're really excited to see a lot of new faces. So let me just give an introduction here. So today we're joined by Colin Rennick and Matthew Bloom from Peak & Hardy Strauss. And Peak & Hardy Strauss is a wealth management firm based in Chicago. It was founded in 1990, and it was the first investment advisor to be certified B Corp in Chicago. This firm is a Principles for Responsible Investing signatory and a member of the U.S. Social Investment Forum. They manage money for individual investors as well as serve as the advisor for Appleseed Capital ESG strategies. So Colin and Matthew are both partners at the firm. Colin is a certified financial planner and focuses his work on firms' sustainable investing initiatives, while Matthew is a certified financial analyst. And along with being a portfolio manager for clients, he serves as the firm's head of ESG research and shareholder advocacy. So today, Colin and Matt are going to be discussing the current state of fossil-free investing. And with that, I'm going to actually turn it over to them and they can say more about themselves.
Great. Thank you, Kyle. Appreciate the introduction and the opportunity to talk to folks today. That was already a good introduction there, but I'll add a little bit more so everybody understands sort of who we are. So like Kyle mentioned, we do advise the Appleseed Capital strategies, which includes the Appleseed Fund, which is a mutual fund that anybody can buy. It's a fossil fuel free fund, and we've been running that since 2006. So we are a boutique firm, 16 folks here in Chicago, very focused on value investing. We have about 750 million in assets. And as Kyle mentioned, we are a certified B Corp. We were the first investment advisor in Chicago to get that. So it's something we're proud of. So today, what we really want to talk about, just a few things around investing according to your values. Because obviously the folks on this call are all passionate about climate-related issues, environmental-related issues, and this is something that's important for us. It's something that we spend a lot of time working on with our clients because our clients are passionate about these causes and a number of others as well. But obviously this is a big one for our clients. And so we want to talk about a few points here. So the first one is the performance myth, which is, there's this belief out in the marketplace that's persisted for a long time that, investing according to certain values, especially divesting of fossil fuels, should somehow have to inhibit your investment performance. And that's really a myth. And we'll talk a little bit about that, and we'll share some data on that. We'll talk a little bit about some tools that are out there that can help an individual investor to really understand what it is that they own in their portfolios, because nowadays with all of these mutual funds and ETF products, it can be really difficult for people to understand what's really in their portfolios, right? They just see the name of a fund or the name of an ETF, and they don't really know what's inside there, and you know what types of industries they are exposed to. So we'll talk a little bit about some things that people can use to help them understand that. And then lastly, we talk a little bit about, you know, what are your values, and what does that mean for your investments? So, you know, I mentioned this performance myth, right? For so many years, one of the strongest or one of the loudest arguments that was made against fossil fuel free investing was this idea that, okay, fine, you can divest the fossil fuels, but you're going to suffer on the performance side as a result of that decision. So, you know, if that's what you want to do, fine, but you're never going to get the returns that you would get with a portfolio that does contain fossil fuel investments. And that's just flat out not true. And you know, we've been hearing it for years, even from investment professionals. You'll continue to hear that, and it's just not true. And that's because, you know, the world is moving away from fossil fuels, and there are so many other ways to invest. There are so many opportunities out there, so many products that do not include do not include fossil fuels, that there are so many different ways that you can still invest and not only obtain comparable performance, but actually outperform in many cases. And that's because, you know, over the last several years, we've seen so much volatility in the fossil fuel markets. You know, like just recently here with the pandemic, we saw a huge drop off in demand for fossil fuels. And that really, really hurt the stocks in the fossil fuel industry. And, you know, that's just one recent example. But so, you know, the negative aspects of that industry have really hurt the investors who do own fossil fuels in recent years. And so it's really, you know, if this is something that's important to you, you don't have to worry about, I mean, and we don't believe that you have to worry about underperformance just because you're divesting of fossil fuels. Now, there are a number of other considerations that you have to make when you're building your portfolio, but this idea of underperformance because you're divesting of fossil fuels is just simply not true.
So this is Colin. I'll jump in now because what we wanted to do is highlight some tools that are out there that would help you figure these kinds of things out. And there are a number of tools that are becoming more publicly available, some that look at, you know, mutual funds and ETFs, as Matt mentioned, and some that even look at individual stocks. You know, US SIF, we mentioned we're a member of, so ussif.org has some, you know, nice sifting tables and tools. Morningstar here, right here in Chicago, is developing more and more information for investors. But today we wanted to highlight one that we especially think is helpful. And that's a group out in California. It's a nonprofit called As You Sow. The website's asyousow.org. And it was founded in 1990. It's led by an individual named Andy Behar. Andy is a really passionate individual who's managed to, you know, put a team together to create great tools and technology that anyone has access to. And it really sheds a lot of transparency on the investments that you have or that you're considering or that a financial advisor is recommending to you. And it gives a lot of information. So we just want to take a minute and highlight his tool a little bit. And I encourage you to visit the website because there's just a wealth of resources there that you should take a look at. I thought that this was really interesting. When I was putting together some information for the presentation today, I came across this blurb. It was an analyst for Morningstar, actually, and the headline was "A Compelling Approach to ESG Investing." And it talked about the Ishares. Ishares is run by Blackrock, which is the largest asset manager in the world. The Blackrock ESG Msci US Leader ETF, okay? And they say this ETF focuses on financially material ESG risks and opportunities. But what was so interesting is if you take a look at this investment and you run it through the As You Sow tool, you'll find kind of a mixed bag. And this talks to what Matt was saying about, you know, what are your individual values? What do you care about? So you'd read the name of this and you'd read this article and you'd think, well, most likely this aligns with my values. But if you take a deeper look, you'll see it ranks pretty mediocre around fossil fuel exposure. It ranks terrible on deforestation, pretty good on gender, pretty good on civilian firearms, fails on military weapons, and pretty good on tobacco. So for some investors, this may be exactly what they're looking for. Maybe gender equality and firearms are their main hot button issues, and they'll compromise on the rest. For individuals on this call, I would imagine receiving a mediocre score in fossil fuels is probably not what you're looking for. So, this is an example of, headlines or names of things cannot be enough. You need to go deeper. Fortunately, like I mentioned, this website is free to anyone, and you can utilize it to take a look. So, looking at this again, an additional example. This is the S&P 500. So when people talk about the stock market went up 1%, mostly what they're talking about is the S&P 500. So we want to look at this just quickly from a fossil fuel standpoint and see, well, if you own the S&P 500, what do you own, right? This is the most commonly held investment for most people across the United States. Well, what you own is 15 investments that are in the top 200 owners of carbon reserves. You own a coal company. You own 26 oil and gas companies. You own 9 coal-fired utilities, and you own 28 fossil fuel utilities. So this does not align with, I would imagine, very many people's values that are on this call today. The good news is, as Matt showed in the performance chart, there's alternatives, right? There's viable alternatives where you don't have to sacrifice anything to have your investments. But my guess is that the average person who's working, has a 401k at their job or is working with a financial advisor probably owns something like this or this type of exact investment. So we just want people to, again, know what they own. What's really interesting though, and I was fascinated by this, is if you look at the Ishares ESG MSCI EFA ETF, so, this is again, sustainable investment, you'll see it receives about the same kind of grade and has about the same kind of holdings. And there's really no additional benefit to you choosing this over just the generic S&P 500. Still owns 15 holdings in the top 200 carbon, still has 7 coal companies, 13 oil and gas, 2 coal-fired utilities, 18 fossil fuel utilities. You gain nothing by choosing this sustainable investment. It didn't help you at all align with your values. So when you read things about Blackrock, the largest asset manager in the world, being really passionate and working really hard toward sustainability issues, take that with a grain of salt, do your homework, do a little bit more research. Compare that to Parnassus Core Equity Fund. Parnassus, if you're not familiar with, is a boutique investor out of San Francisco, California. They've been around a long time. They're considered a top both performer from an investment standpoint, as well as from a sustainability standpoint. You run their investment, which is a large cap US. It's not as many holdings as the S&P 500. It is an actively managed fund where the individuals at Parnassus are sitting down and looking at the portfolio and choosing what they feel like is appropriate, both from a making money standpoint and a aligning with your value standpoint portfolio. But what you'll find is they receive excellent scores. They have a mandate to run a sustainable fund. So does that ESG fund I showed you in the previous slide, but you'll see this owns 0 holdings in the top 200 owners of carbon reserves. So my point is here again, there are excellent tools out there. They can really shed a lot of light on what is inside of these mutual funds and ETFs, which I guess is the majority of people on this call and the majority of investors, period, own in their portfolios. We are happy to help individuals who have questions about this, but it's all out there for you. So if you're someone who likes to do research, likes to learn more, I encourage you to check out this and some of the other tools I mentioned. And again, if we can help at all, because we're pretty familiar with utilizing this tool for our clients. If we can help you at all with just navigating it, feel free to follow up with us after the call, and we're happy to point in the right direction. Matt's going to take us over and dive a little deeper into another sector that we feel like you should keep your eye on.
Thanks, Colin. So, we're just talking more about directly, investing, in fossil fuel companies, and how you can use these tools to figure out which companies you do have exposure to. Well, one of the things that I think is maybe lost on a lot of folks is that just because you maybe don't own any actual fossil fuel, you don't own an oil drilling company, you don't own a refining company, you don't own a coal-fired utility company, that doesn't mean you don't have significant exposure to fossil fuels, because the banking industry is who finances these projects, right? So this slide here is really interesting because this shows how much financing is being provided to the oil and gas industries by the major banks. So, it should be clear in looking at this that if you are banking with a major bank, or you are a shareholder of a major publicly traded bank, you really are contributing to the financing of these significant oil and gas projects, these major oil and gas companies, because they have to get their capital from somewhere. And so one of the things that we did a number of years ago is we divested of all major banks, in addition to not having exposure directly to the fossil fuel companies themselves. And so I think this is one of the things that a lot of folks don't realize is that you can't just stop at that first level. You really need to take another step down. As the slide says, go a step deeper into the pipeline and understand where these companies are receiving their funding and their financing for the projects that they're doing. I'm sure that most of the folks in this call would not have any interest in directly contributing to the financing of these companies, but they may not realize that a company that, a bank that they might own shares in, or a bank that they might be personally banking with is funding those projects. So, and that really is, going against a person's values. So I think that slide's very interesting in that regard. And here's something that I think a lot of investors actually missed. But this happened. These headlines came out a few weeks into the coronavirus situation that we're dealing with, and so a lot of the oil and gas projects that are going on in the United States are basically bankrupt, right? The shale boom has really gone bust in the U.S. because oil prices came down so far that these projects were no longer profitable. And these companies are highly levered. They have a lot of debt to fund these projects. And when oil prices dropped, they basically had to default on a lot of this debt. So what's happened is you have major US banks literally now taking over and running oil and gas businesses. So it used to be, one step removed, right? They were just funding these projects. Now they're literally running oil and gas fields. So they're setting up these like shell companies, that are effectively controlled still by the major banks, and these companies are just running oil and gas businesses. So these banks are now effectively fossil fuel companies. So it's something to make you think about your banking relationships and your ownership or potential ownership of, like, JP Morgan shares or Wells Fargo shares. Understand what it is that you own, and understand who it is that you're doing business with when you have these banking relationships, because there are alternatives out there. There are community banks who are taking the capital of depositors and redeploying that in our communities and doing great things with it. And they can provide all the banking services that these large banks can provide. So just something to think about when you're considering who you're doing business with and what companies you own, because effectively these are oil and gas companies now. So I think it's an important consideration. And here's one more thing that I think is really interesting. just because you might not own an oil and gas company, think about the other businesses that are in your portfolio, and think about how those companies contribute to emissions here in the United States. Because, for example, I think one thing that this is one of those really sort of difficult topics, but we all are excited about the electrification of automobiles and the move toward EVs, but we have to keep in mind that electricity in the United States, electricity generation still contributes roughly a quarter of all emissions in the US. And so your EV is still powered by something that is probably emitting greenhouse gas. And so, obviously we're moving toward a more solar and wind powered, renewable powered energy grid. But at this point in time, still the electricity generation in the US is contributing roughly a quarter of all greenhouse gas emissions. And so we have to keep in mind, again, that we have to go to that second step down, right? We can't just say, I don't own the fossil fuel companies, but the companies that you do own, or the other things that you're doing, may still be contributing in a meaningful way to greenhouse gas emissions. And so it's, I guess the point of this is just to get everyone to think a little bit harder, think, beyond the first order effects to the, step down to the second order, third order, and understand what it is you own, and how it is that your behavior might be contributing to this sort of thing, and then think about what the alternatives might be to that. So, Colin, you want to step in here?
Yeah, so, just to summarize, our opinion on, the great next steps that people could take, and hopefully, you can, as this webinar is being recorded, you can share that with others that that have similar interests. But again, we really encourage you to check out some of the tools that we had talked about. Another, step for some people would be to talk to a financial advisor who specializes in sustainability. Unfortunately here in Chicago, those numbers are a little less than other parts of the country, but, we're coming around, and there's certainly people here in town that, can help you. And we're happy to make introductions to people or even, help you ourselves. And then another thing to think about too is, especially if you work for a smaller business, is, do you have any sustainable investment options in your retirement plan at work? And if not, is that an option? If you work for a large corporation, obviously this is probably a conversation that won't get very far. But if you work for certainly like a B Corp or a smaller business, or a business that's aligned with sustainability, so it's fascinating to me that you could have a business that's core business is in the sustainability space, and they don't offer any sustainable investments in their 401k plan. So we really encourage people to do that. Another thing I want to mention is, for some people, going deep down, as Matt described, kind of in second and third tier of really making sure you have as low of an impact portfolio as possible on the climate, it can be difficult for individuals getting started, just starting saving, or within a 401k, if that's mainly your savings. You're going to have restrictions, and there's unfortunately going to be some compromise that you might have to make. For people that have accumulated more wealth, they do have more flexibility, if we're being honest. But there's still definitely steps that you can take to make your portfolio as aligned as possible. And we want to come on today and hopefully offer up some of our expertise and give you some good first steps, and get people on the right track. So we're happy to answer questions. I'm not sure if any came through on the text line. Kyle, I don't know if you want to check that or read those off, or if anyone wants to unmute and ask Matt and I any questions. We're happy to stay on as long as needed.
Thank you both for that presentation. I think the only thing that came through on the text chat was actually me linking to an article. It's got a really good graph towards the bottom where when you were talking about the myth of investing and people thinking that they are going to automatically get lower returns whenever you take a piece of the pie out. So it actually shows that over the last decade, the S&P index, fossil fuels have been the worst performing sector. So, I mean, there's a lot of talk that we get in this group about the difference between full divestment and trying to remain in institutions as a shareholder and urge responsible acting. And there's a lot of good points on both sides, but where I personally myself and some other people would fall is say that we've had a long time where people have urged responsible acting and it has not made as much of an impact as quickly as the divestment movement has been shown to make in the last 10 years. Blackrock's move that you talked about it made a lot of waves because it brought headlines. The substantial effect of that might not be really felt, but I don't think that would have happened if they didn't see a portion of their business start to go away. Anytime a business sees their piece of the pie growing smaller and money they're never going to see again, when they've been performing that poorly, it doesn't make them feel good about continuing business as usual. So that was kind of the only thing that has been shared so far. I had a couple other things that I wanted to ask, but I don't want to dominate the discussion time. So I'll kind of open it up if anybody else wants to ask questions first.
I have a question. This is Babette Newberger. I want to thank you for your presentation today. It was really helpful. Can you all hear me?
Mm-hmm.
Okay. So my question, I've been thinking about this a lot in terms of finding better funds that I'm invested in. And I'm wondering is there any recommended protest action or things I should be doing as I move funds around to better investments to kind of make the point about why I'm doing that, or even closing my bad bank account, to make a statement. I just don't know how to do that in such a, as a small individual.
Yeah, so that's a great question. So that's a tough thing. Obviously, JP Morgan is a really, really big company, right? They're just a huge bank. And so if you close your account, I'm guessing Jamie Dimon isn't going to get a letter across his desk letting him know about it. But that doesn't mean that it doesn't have an effect, that it doesn't have an impact. Because if you do it and then Luis does it and Kyle does it, and a whole bunch of people do it, it does have an impact, and then Jamie Dimon will hear about it. But beyond that, actually, I mentioned briefly, there are these community banks out there, and we have some great ones right here in Chicago, where you can close that whatever banking relationship that is that you might have with one of these big banks, and maybe they don't feel it, right? But I'll bet that if you go to one of these community banks and take your money there, they will feel it in a positive way. And this is a bank that, can go out and lend your money to a small business owner in a community that's been, disinvested, or has, some kind of, plight there where they could take that money and put it to good use, and you can actually be building up, the city of Chicago. So I would encourage you to look at things like that. Again, the idea of sort of, letting them know, letting these bad companies know what you're doing is hard to do because they're so large, and each one of us maybe can't move the needle on that side of things. But I think we can move the needle on the positive side of things, especially in the banking space. So, and if you would like a list of community banks here in Chicago, we can provide that to you, because we as a firm, we do our banking with Chicago community banks, and within our investment strategies, we hold a portion of our cash at all times with various community banks. So we have a lot of relationships there. So that's something I would encourage you to do.
The other thing I'll add really quickly is I think the most powerful thing you could do is tell people that have similar values to you that this is even something they could think about or do. I have conversations all the time with people who are like, oh, wow, I've never even heard of that. And these are people that are educated, that have investments, who, you know, you would think are very familiar that this is an option, and they have never heard that they could do this. They have no idea. You know, social media is a powerful engine. You know, if someone you know posts something about, you know, an anti, you know, firearms investing, you know, I always let people know, hey, there's tools out there that you can look and make sure you don't own any. So that's what I try to do, is just constantly talk to my own personal network that this is a thing, and you'd be shocked to know how few people realize that it's the case.
Thank you both. I just posted a link to a presentation that we've given in the past that kind of goes over that. If you did specifically want to close your account, what Matt and Colin were talking about, letting the manager know as you're closing it, because they'll usually try to come up and say, you know, what can we do to keep your business? Whenever I had Chase when I first started banking over a decade ago, and I didn't know what I was doing, but I closed my account with them, and I think I was the first person that had ever told that branch manager I was doing it because of climate change. But there's a list of things that you can do, as they said, share it on social media, raise awareness that this is something that's important to you. There's lots of community banks that they had talked about, like community development financial institutions. There's a list in that presentation where you can find ones in your area, or maybe ones that specifically target certain subsections of the population that have been historically underbanked or ignored from the banking community. So please take a look at that. But also, yes, feel free to reach out to Matt and Colin if you want some help there. It looks like we've got another couple of questions here. Is there a low-cost fees way to invest in passive equity indices without problematic assets, fossil fuels, prison industrial, et cetera? If so, what does that risk-return profile look compared to benchmarks?
Yeah, so you know, Colin brought up some of those ETFs earlier, and showed how some of those, even though they had the sustainability mandates and had it, you know, ESG leaders in the name, they weren't exactly the best when it came to really digging in. There are some, I think, some low cost, decent products out there that really, you know, that'll score a little better, but you'll have to dig in. And the new ones are popping up all the time. So it would be impossible for me to give you a list of you know, oh, this one, and this one, because there's new products that even we don't know about that are coming out of the woodwork all the time. What I would say is use the tools at As You Sow, use the tools on Morningstar, dig into them, and then like the slide showed earlier, pay attention to the different values and the things that are important to you. So if fossil fuels are really important, you know, divesting of fossil fuels, then make sure that when you use that tool, you see that, hey, that in that area, this product performs really well. But you may have to make some trade-offs there. You probably aren't going to find the perfect product, you know, because that's very difficult. But when it comes to the risk-reward trade-off, I would say that generally speaking, again, if you're willing to make a few compromises in certain areas, I think that you're going to get comparable risk-return to the benchmarks with a lot of these products. You know, again, you might not be able to 100% divest of fossil fuels and animal testing and civilian firearms and tobacco, and you know, eventually you're going to have to make some kind of compromises in certain areas. But I think that you really can find something that matches with your value system that that's going to give you performance that's comparable to the benchmarks, because there are just so many investments out there now that you know, you should be able to find something in that regard, but it will probably take some work with some of these tools to find them.
All right, thank you. Let's see. We have a couple other questions here now. I work for a large company and I have been trying to get it to offer sustainable 401k. Do you know of any large company that does it?
Not offhand. You know, the issue here is always the same argument that, you know, we can only offer a certain number of choices. And what we've seen some large companies do, though, that will make this work is that they'll have their kind of basic list of 15 things you can pick from. And in that case, that's where the issue lies. But what they'll also do is they'll give employees an option to do like a self-directed, you know, more open architecture kind of plan. And definitely some larger companies offer that. And then that would be like, I'll just give a generic example. It'd be, you know, you'd have the ability to use Charles Schwab and use 1,000 different funds. And then, you know, when you get that bigger pool, then it's easy, right? And then you have those things available to you. But as far as, you know, adding sustainable funds within that shorter list, it's usually kind of token investments. You know, they'll throw in like a bond fund that doesn't buy tobacco and they'll say, here you go. That's what I've seen. I don't know if Matt, do you have any other examples?
Yeah, so there, I have seen some large corporations who are offering some ESG and SRI type of investments. Usually, it's a pretty small number of investments that are more sustainable, but they're at least throwing a few in there. It's still relatively rare with these large corporations because really what they're just, they're trying to basically please, tens of thousands of employees, and they just say, look, here's 10 or 15 options. But like Colin said, we are seeing more and more frequently this idea of like this self-directed brokerage portion of a 401k, where the employee can take a portion of their 401k assets and put it in this other platform where they can buy, basically anything that that custodian offers, whether it's like Fidelity or Schwab or whomever. That's becoming fairly common, especially with large corporations. I know that GE does that. I know that United Airlines does that. American Airlines does that. Because we have clients who have 401ks with some of these companies, and they have those options within their 401ks, and we've been helping them to take that portion and direct that in a way that's more aligned with their values. So if you're you're working for a large corporation, you don't have some of those investment options available, you should check and see, is there the possibility that you can do this self-directed portion that would give you a much larger universe of investments, and you would just have to speak with someone, in the group that's managing the 401k.
I just wanted to say one real additional thing to caution people. Let's say you do have a 401k and they give you 15 choices. Usually the reason for that is so that you can build a diversified portfolio, right? If one of those options is a sustainable investment that aligns with your values, I'd caution you against putting all of your money in that one investment. Diversification is important. We've seen that in 2020, where the stock market's gone, rapidly up, down, and back up. If you have all your eggs in one basket, it's a wild ride. So I just really caution people against, going against diversification for their values. What you want to do, if you really feel like you have to go that route, is make sure that you have money outside of your 401k that balances that out. And again, that's the kind of thing we do with some clients who, really are passionate about this, is we try to balance their entire portfolio. So you have 401k money, maybe you have some additional savings. Let's make the whole thing diversified. That's an option. But I just want to throw that out there as a warning, just to be careful and not take on too much risk and put everything in one particular investment. Yeah,
because if, like Colin says, if you only have this one sort of token ESG investment, you got to be careful not to overweight that. That's a great point.
All right, the next question, I guess, is more of a comment on a previous question that we had. As far as protest or ending your relationship with your banks, 350 has worked in the past with the Stop the Money pipeline and various protests against Chase and its fossil fuel investments. So that's kind of a ongoing allyship that we have with Stop the Money Pipeline. I know that Extinction Rebellion and Sunrise Movement, other environmental organizations in the Chicago area have had those actions, and we've been a partner in that. We have another question here. I'm not interested in moving all of my investments. What's the possibility of starting some smaller investments either individually or through your company?
Yeah, that's certainly something that we can help with. We have a platform where we can provide some investment portfolios to people who are just kind of starting small, and it's a fully online setup. It's very seamless. It's very easy to get started. And so that is something that we are able to offer folks now who are just kind of wanting to dip their toes in and start with something smaller, but get access to some screened ESG and SRI fund products. That is something that we can help with. So if somebody wants to speak with us offline, or we'd be happy to talk about that.
Yeah, I'll just add, really for anyone on the call, we're happy to have an initial conversation with anyone that wants to learn more about either something we talked about today or more about our business. So if you have any interest, on the slide, I think it's on the screen, is both my email and Matt's email, as well as the websites of our firm. Check it out. If you have questions, just shoot us an email. Happy to, chat with you on the phone or answer questions through email.
Yeah.
All right, thank you. And then Jerry shared an additional link in the chat that is to our 350 Chicago website's divestment page, which includes that link to the divestment for personal finances presentation that I had shared earlier. And that is a little bit more, the presentation that I had shared is a little bit more focused on like credit cards, debit cards, a couple other things that are a little bit less, I guess, scary than thinking about where you're going to put your 401k or your retirement. But it is quite easy to move your checking account to another bank that is more aligns with your values. So that's more what that was about. But the page that Jerry shared is a little more holistic. Another question here. Is it possible to transfer a 403B once you're no longer contributing to it, having retired?
The answer is absolutely yes. You can take a 403B and you can leave it there, or you can roll it into an IRA with another custodian, and then you would have broader control. You would basically be able to put that money you could direct it however you want, into whatever investments are available to that custodian. So that's what a lot of people do when they retire. They take their 403B or 401k, roll it out to an IRA, and then they could direct that in any way that aligns with their values.
All right, thank you. And then the last thing that we have here, speaking of diversification and slightly off topic, do either of you know why utilities are fighting the transformation to alternative energy instead of choosing to add that business to their own? Seems like such a short-sighted business decision to me. And I mean, just off the cuff, I guess I would chime in here and say that when you operate as a monopoly or an oligarchy, there's less business forces, I guess, acting on you to move as quickly, because people can say, I want my electricity company to be greener, but you don't really have a lot of options to just say like, well, if you don't do it, I'm going to get electricity from somebody else. So that's one thing. But making large companies do anything that's not their idea and they think is going to optimize money and minimize transition costs is going to be difficult. But we are starting to see a lot of victories in that. But Colin and Matt, did you think that?
Sorry, I'll add too. I saw a couple of presentations at the end of 2019. One was by a utility, and they were really talking it up, talking about their how serious they're taking different sustainability issues and how much work they're putting into their grid. but how much of that is just kind of lip service is always difficult to say. But I did see a presentation from another energy, and he was an energy investor, but somebody who's really in the weeds, like this is his life. And the point he was making is that there's the belief within the energy industry, specifically, I would say, I guess, utilities, that we, with current technology and even technology that's on the horizon, it's going to be difficult to transition past like a 50-50 mix. So, I think that when that's the kind of running belief, there's less incentive to really push the needle, right? If in a best case scenario, we're at a 50-50 alternatives versus traditional, to Kyle's point, there's not a lot of incentive to like push real hard. So, and that was, again, a presentation I saw in November of 19, so fairly recent.
Yeah, I think Kyle made a great point about sort of like the business drivers. Utilities they're basically legal monopolies. Governments set up this structure so that these monopolies exist. And they don't have the sort of traditional capitalist, action, or they don't have the capitalist forces acting on them in the same way that a retailer does, where you say, hey, I don't like the way you do things, I'm gonna go, I don't like you, Nike, I'm gonna go buy Adidas or whatever. It's really, really easy to vote with your dollars in other industries. Utilities, it's nearly impossible to do. So people don't have a lot of choice, and so the businesses don't have a lot of incentives to change their behavior. And one of the other things I think too is that first of all, transition, it takes a lot of capital, because you do have to invest in the new technologies. So there's always this sort of like inertia with things like that, where businesses that have been doing something a certain way for a long time, they have the existing infrastructure. Yes, the long term argues strongly for them to make some changes in technology, and really move down this new path that really is the long-term path. But there's always just resistance to that because it's hard, and so that when you combine that with the lack of sort of capitalist forces on these utilities, they'll get there eventually, but they'll only do it when it's the last option, unfortunately. They'll make these transitions, but they will make them begrudgingly.
Yeah, I think inertia is the key word that I picked up on there. Is like,
Yeah.
If that's where things are going and they can see that there's a market there, then that's where they'll put their investment. If people are not pressuring them to do anything, then inertia remains static, and then they can continue making money. It's like we said, a monopoly. They have an obligation to serve by being a monopoly. If you turn the lights on, the electricity better come. That's the expectation, but they're not playing by the same rules as other companies. I'm not seeing any other questions, so I did just have a couple other things I wanted to add that we went over in the discussion. So this is going to be maybe a little disjointed, but I'll bring them up. So we've talked about investment strategies. One thing that I was also thinking about is insurance. So we've had a lot of good victories against pipelines, even in the last week. If you've seen the news from the Supreme Court, talking about stopping Dakota Access, and I think there was another one on the Eastern Seaboard that was blocked recently. But these are they're going to keep popping up as long as oil and gas and coal is still profitable. Coal is very much on the end of it's in its last legs, I think. But oil and gas, we're going to have to keep fighting these. This is a constant Gardner situation. And one thing that we can do is not use insurance companies that also back pipeline projects. So I know that for my apartment insurance, I had previously had Liberty Mutual, and then I realized they were actually one of the largest pipeline insurers in the country. So that's another thing that you have control over with the consumer decisions that you can make. There are other options, like Lemonade is a new insurance company that is also a certified B corporation. that you have complete control over. And again, when we reach a social tipping point where enough people do that, then we're going to start putting major pressure on and stop pipeline projects from being able to exist as they do today. So that's something we can do. Like I said, I use Lemonade. There's probably other ones that have sustainability mindsets at the core value. Electricity generation, we were talking about EVs and kind of the mix of fuels that each region has, I guess. And if you have an EV out in California where more of the energy mix is renewables, then your carbon footprint is going to be lower than it would be in an area that is heavily using coal. But even with your energy mix, having coal and having fossil fuels to generate the electricity that your electric vehicle is running on, that your carbon footprint is still lower when you use an electric vehicle than straight tailpipe emissions. I believe it's called well-to-wheel emissions. And within the first 6 months of driving an electric vehicle, I think the tipping point is reached where you start actually offsetting the extra emissions that it takes to make an electric vehicle versus a internal combustion engine vehicle. So that's just something to keep in mind. As our energy mix continues to get greener, that equation gets even more and more skewed for the reason to buy electric vehicles. Also, there's lower maintenance cost every year, and you just pay less after the initial bill. They are still a higher average cost for a new vehicle, and there's not a lot of used electric vehicles out there as much as there are internal combustion engines, because people, once they switch to electric vehicles, usually aren't putting them back on the market as soon. What's another one? Oh, so, and then electricity, I'm going to do a shameless plug here for a partner that we have called Hero Power. And so the renewable energy credits that, if people are familiar with that, it's basically offsetting carbon footprint. We have a partnership with this company called Hero Power, and it would, if you signed up for their service, you are offsetting 100% of your carbon emissions with renewable energy credits at no extra cost to you. This is something that they're able to do while still having ComEd be your supplier of energy. But within 2 minutes, if you have your account number, you can sign up for their service, and then 100% of your energy is offset with renewable energy credits, and you get $25 off your first energy bill, and $25 will be donated to 350 Chicago. And we are registering as a nonprofit right now. So that's something that you can look more into on our website. It's a really cool initiative that also is described a little bit more in depth in that divestment presentation that I had shared earlier, but that's something to look at. Let's see. I think that was the main couple of points I just wanted to make sure that we hit on before wrapping. Does anybody else have any other questions for Colin or Matt, or just in general for the group? All right, well, if you do have questions that come up and, or maybe you're not wanting to ask them in front of the group, it's a little bit more personalized to your situation, please take note of Colin and Matt's contact info there. We will also be making this presentation available online on our website within the next couple of days, so you can look at it then and take a deeper look on your own. But thank you so much, Matt, Colin, for sharing with us today, and everybody for joining. It was a really great presentation and a discussion afterwards.
All right, thank
pleasure.
you, everyone.
Yeah, thanks for having us.
And it looks like we have a couple questions about Hero Power. Jane, do you maybe want to stay on the line after we end the presentation? We can ask about it?
Yes, thank you.
All right, sounds good. All right, if anybody else wants to drop off, then that's great. So Jane, I believe when we spoke with the founders of Hero Power, they basically are able to do this because they have what did they say? Jerry, maybe you'll have to help me on this one, but they put the ComEd price per kilowatt hour on their homepage and guarantee that you will never pay more than that. So it's very visible. And so Jerry, did you post? Yeah, so if you go to that link in the chat box, it'll go about talking more about our partnership with them. You can go to their homepage. It shows the price per kilowatt hour. And I think they're saying because they're growing and they have visibility into the next couple of years of their business operations, they basically don't need to make a profit on this by charging people more. They imagine that they're able to have additional business revenue streams. Like they're getting into, I wish I had them on here because they're much more fluent in talking about this. They're able to offer like points towards renewable projects that you can upgrade your house with, like energy efficiency upgrades, things like that. But this is just an aspect of their business. So it's just kind of, it's not a loss leader, but they're not needing to make money by charging people there. That's not how their business is set up.
So just to interject, Kyle, to be honest, I'm trying to remember the specifics of what they said also, but the nice thing here is that Hero Power did a presentation for us just a couple of months ago, and that is recorded. So if you're looking for those actual details, they explain how they're able to do that in that recording. And you can find it on that link that I shared. It includes the link to the Zoom meeting that we had with them, and they explain exactly how that works.
Can we just dub over what I said and then like put audio from what they said right there? Because that would be a lot better.
Thank you.
Yeah. But yeah, I think that was, I don't see any more questions in the chat box. So, hopefully people, reach out to Colin and Matt and move those investments. I did it myself a couple of years ago with a different financial advisor. I didn't know about you guys yet. I'm sorry. But yeah,
We'll forgive you.
it wasn't that painful. And now I know exactly what I own. I support my values with my dollars. And I've actually, COVID hit everybody's investments, I think, but I've actually seen a uptick again, and I'm invested in renewable energy and clean water technologies. And I've actually seen it rise in the last couple of months. That's not a endorsement of saying you're going to, always see positive returns. The market is what it is. But this myth that that Colin and Matt talked about is still very pervasive, even though we have a lot of data points saying the opposite. So
I can echo that, Kyle. I think you remember me saying that I also divested my portfolio, and not to belabor our discussion here, but it was a fascinating situation, and I didn't know about Appleseed either. Had I known, I'd be talking to you guys, but I worked with, and still work with, Northwestern Mutual. So I had an advisor for a decade, maybe more, and he's a great guy. But what was really fascinating is that he didn't really have much knowledge of ESG or fossil fuel free investing. And even when I asked for that, it was this really interesting dynamic where at first it was like, well, yeah, if you're interested, we could kind of talk about that. So he didn't say no to me, but he didn't really engage me on that. So I asked him again, and it was like the third time I finally said, I'm serious about this. And he understood at that point, and he actually had to reach out to a colleague who had experience with ESG in order to get me the investments that I needed, which was great. I mean, he worked it out, but I found myself educating him, which was really fascinating. And ultimately, he got me a nice spread that included a lot of Calvert funds. But yeah, it wasn't easy, and I wish I had known about you guys and other groups. And obviously, I think as time moves on here, our team learns more and more about organizations like you that have investment advisors available to give people some guidance, because it's hard. But I think it's getting easier. The more time goes on, the more people want to align investments with values, whether it be fossil fuel free or other this becomes easier to access.
Yeah, it's your story is not uncommon. There's for whatever reason there continues to be just especially among the advisor community, there's sort of like an aversion to it, or they just kind of like they just say, I don't think I really understand, so I'm just going to kind of avoid it and ignore it. And but like your story, you sort of had to broach the topic, and you had to sort of educate your advisor on that. And we hear stories like that a lot, which I think is crazy because there have been some studies that show that advisors who bring this to their clients and have this conversation actually build deeper relationships with their clients, because they're connecting on something that's really, really important with their client, that their client is really passionate about. And I think, and the client, I think, gains a different type of sort of respect for the advisor when they say, hey, this guy gets me, this woman gets me. Like we're really seeing eye to eye on this. But there continues to be a huge sort of like pushback by advisors, which is crazy.
I'm just realizing that I kind of had people log off before I gave maybe some next steps or some more information on our group specifically. I still see a couple of people on here though that I want to make sure that we talk about our subcommittees that are ways to get plugged into our work. We have a communications team, which kind of is the overall voice of the group, make sure that internal and external communications are all in the same voice, I guess, and that we're coordinating across platforms. We have an education committee where we plan these events and reach out to speakers like Matt and Colin and make sure that we have a lot of good content for our local chapter. There's an events committee, an outreach and new member committee. There's a research committee, there's a fundraising committee, and those are kind of self-explanatory, but there's lots of different ways that if you're interested in getting more involved in the group, you can reach out and we'll make sure that we utilize your talents. So if you're interested in that, then I would say either contact us through the info@350chicago.org email that we have, or just there's links on our website that you can go through, and I think we've shared several of those to navigate to. I believe that our next meeting would be the first Saturday in August, same time, still virtual, but 10 a.m. the first Saturday of each month. I'm not sure if we have a speaker lined up just yet, but we're always looking to have more events in the community, even in the time of COVID and being virtual everything. We'd really appreciate if anybody wanted to join and could definitely use your talents. All right, well, thanks everybody for joining. Thanks Colin and Matt again. We'll sign off now.
Thanks, Colin, Matt. Thanks, everybody. Everything went all right. Seems like no issues on your end, Kyle?
I don't think so, other than just stammering. Are we still recording?
Yeah, actually we are. Oh,
Yeah.